This is the lecture part 2 of chapter 10 as we continue on with our property, plant, equipment, and intangible assets in intermediate accounting. So companies sometimes acquire assets without paying cash at the time of purchase. In part B, we're going to look at 4 situations where this occurs. Deferred payments, which would be a notes payable, issuance of equity securities, donated assets, and exchanges of non-monetary assets for other assets. Now, the controlling principle in each of these situations is that in any non-cash transaction, the asset acquired is recorded at its fair value. The first indicator of fair value is the fair value of the assets, debt, or equity securities given. Sometimes the fair value of the assets received is used when their fair value is more clearly evident than the fair value of the assets given. So a company can acquire an asset by giving the seller a promise to pay cash in the future and thus creating a liability, which would normally be a note payable. The initial valuation of the asset is quite simple as long as the note payable explicitly requires the payment of interest at a realistic interest rate. So suppose a machine is acquired for $15,000 and the buyer signs a note requiring the payment of $15,000 sometime in the future, plus interest in the meantime at a realistic interest rate. The machine would be valued at $15,000 and the transaction would be recorded as shown here as machine for $15,000, note payable $15,000. On the surface, it might appear that Midwestern's paying $50,000 for the furnace, the eventual cash payment. But when you recognize that the agreement specifies no interest even though the payment won't be made for 2 years, it becomes obvious that a portion of the $50,000 payment is not actually payment for the furnace, but instead is interest on the note. At what amount should Midwestern value the furnace and the related note payable? Well, as you see here, the answer is the fair value, as it is for any non-cash transaction. This might be the fair value of the furnace or the fair value of the note. Let's say in this situation that the furnace is custom built, so its cash price is unavailable. But Midwestern can determine the fair value of the note payable by computing the present value of the cash payments at the appropriate interest rate of 10%. The amount actually paid for the machine is the present value of the cash flows called for by the loan agreement, discounted at the market rate of 10% in this situation. So the present value of $50,000 would be really $41,323 when the interest rate is 10% and the number of periods is 2. So assuming that Midwestern's fiscal year end is December 31st and that adjusting entries are recorded only at the end of each year, the company would record the entries shown at the end of 2018 and 19 to accrue interest and the payment of the note. Sometimes the fair value of an asset acquired in a non-cash transaction is readily available from price lists or previous purchases. In that case, this fair value may be more clearly evident than the fair value of the note, and it would serve as the best evidence of the exchange value of the transaction. In this situation, we infer the present value of the note from the fair value of the asset. Now remember, the difference between the note's $79,383 present value and the cash payment of $100,000 represents interest. We can determine the interest rate that is implicit as shown here. The $79,383 present value is equal to the $100,000 face amount times the present value factor. So the $79,000 is really, by dividing the $100,000, is 0.79383%. So the present value of $1, or a single amount, when the number of periods is 3, and in this case the interest rate would be 8%. We refer to the 8% rate as the implicit rate of interest. Denison records interest each year at 8% in the same manner as was in the previous illustration. So, another concept question for you. On January 2nd, 2018, Edgar purchased a machine and signed a non-interest-bearing note in payment. The note requires the company to pay $200,000 on December 31st, 2020. Edgar is not sure what interest rate appropriately reflects the time value of money, but the price list indicates that the machine could have been purchased for cash at a price of $120,000. So what would Edgar record the asset on January 2nd? Well, if the list price would show $120,000, then that is what we would record the asset for. As you see here, sometimes the fair value of an asset acquired in a non-cash transaction is readily available from price lists. In that case, this fair value may be more clearly evident than the fair value of the note, and it would serve as the best evidence of the exchange value of the asset. The most common situation in which equity securities are issued for property, plant, and equipment, along with intangible assets, occur when small companies incorporate and the owner or owners contribute assets to the new corporation in exchange for ownership securities, which is normally common stock. Because the common shares are not publicly traded, it's difficult to determine their fair value. So in that case, the fair value of the assets received by the corporation is probably the better indicator of the transaction's exchange value. In other words, particularly those involving corporations whose stock is actively traded, the market value of the shares is the best indication of fair value. Assets acquired by issuing common stock are valued at the fair value of the securities or the fair value of the assets, whichever is more clearly evident. It's the fair value of the common stock. If the fair value of the common stock had not been reliably determinable, the value of the land is determined through an independent appraisal, would be used as the cost of the land and the value of the common stock. On occasion, companies acquire assets through donation. The donation usually is an enticement to do something that benefits the donor. Like the developer of an industrial park may pay some of the costs of building a manufacturing facility to entice a company to locate in the park. Companies record assets donated by unrelated parties at their fair values based on either an available market price or an appraisal value. This should not be considered a departure from historical cost valuation, but it's an equivalent to the donor contributing cash to the company and the company using the cash to acquire the asset. GAAP requires that donated assets be recorded as revenue. Note that revenues generally are inflows of assets from delivering or producing goods, rendering services, or other activities that constitute the equity's ongoing major or central operations. Now, the rationale is that the companies receiving the donation is performing a service for the donor in exchange for the asset donated. Corporations occasionally receive donations from governmental units. A local governmental unit might provide land or pay all or some of the cost of a new office building or manufacturing plant to entice a company to locate within its geographical boundaries. This slide here provides an example. The City of Westmont agreed to pay 20% of the $20 million cost of building in order to entice Elkhorn to relocate. So the amount of donation is for $1 million, and revenues credited for this amount and land is recorded at $20 million. Elcom pays the remaining amount, $16 million, in cash. So another concept question for you. Shackelford Corporation acquired a patent from its founder, Jim Shackelford, in exchange for 50,000 shares of the company's no-par common stock. On the date of the exchange, the common stock had a fair value of $22 per share. What's the cost of the patent? So when the common stock is actively being traded, the market value of the shares is the best indication of what fair value would be. So the market value of the stock would be the 50,000 shares times $22 per share, or $1.1 million. Both GAAP and IFRS require that companies value donated assets at their fair values. For government grants, the way that value is recorded is different under the two sets of standards. Unlike GAAP, donated assets are not recorded as revenue under IFRS number 20. It requires that government's grants be recognized in income over the periods that are necessary to match them on a systematic basis with the related costs that they are intended to compensate. So for IAS 20, it allows two alternatives for grants related to assets. First, deduct the amount of the grant in determining the initial cost of the asset, and then record the grant as a liability, deferred income, in the balance sheet and recognize it in the income statement systematically over the asset's useful life. Here we go again, another concept question. So the County of Santa Clara gave a parcel of land to the 49ers Company as part of an agreement requiring the 49ers to construct its football stadium on the donated land. Now the land cost the county $12,800,000 when purchased several years ago and had an appraised value of $20 million on the date it was given to the 49ers. As a result of the donation, the 49ers should record A, a credit to retained earnings of $20 million, B, a debit to land of $12,800,000, C, a credit to revenue of $20 million, or D, all of these answers are incorrect. What do you guys think? Well, it should be revenue. It was donated. GAAP requires if a company receives a donated asset, it must record revenue at an amount equal to the fair value of that asset. And in this case, it's $20 million. So the property, plant, equipment, along with intangible asset acquisition decision is among the most significant decisions that management must make. A decision to acquire a new fleet of airplanes or to build or purchase a new office building or manufacturing plant could influence a company's performance for many years. These decisions, often referred to as capital budgeting, require management to forecast all future net cash flows, cash inflows minus cash outflows generated by the asset. These cash flows are then used in a model to determine in the future cash flows, if the future cash flows are sufficient to warrant the capital expenditure. One model, the net present value model, compares the present value of future net cash flows with the required initial acquisition cost of the asset. If the present value is higher than the acquisition cost, the asset is acquired. A key to profitability is how well a company manages and utilizes its assets. Financial analysts often use activity or turnover ratios to evaluate a company's effectiveness in managing assets. PPE are usually a company's primary revenue generating asset. Their efficient use is critical to generating a satisfactory return to owners. One ratio analyst often used to measure how effectively managers use PP&E is the fixed asset turnover ratio. This ratio is calculated by fixed asset turnover. The ratio equals net sales divided by the average fixed assets. The ratio indicates the level of sales generated by the company's investment in the fixed assets. So the denominator usually is the book value, sometimes called carrying value or carrying amount, which would be the cost minus the accumulated depreciation of the property, plant, or equipment. So as with other turnover ratios, we can compare a company's fixed asset turnover with that of its competitors, with an industry average or sector, or with the same company's ratio over time. So let's compare fixed asset turnover ratios for GAAP and Ross Stores that are both companies in the retail apparel industry. So the 2016 asset turnover for GAAP is 5.62, which is the 15,797 divided by 2850 plus the 2773 divided that by 2. Now we can compare that to the turnover for Ross stores of 5.17. Again, the 11,940 divided by the 2343 divided by the plus the 2,274, and then we divide that by 2. Gap, as you can see here, is able to generate 45 cents more in sales dollars than Ross stores for each dollar that's invested in fixed assets. So here we go with another concept question. Hubert Corp and Winslow Corp reported the following information. Calculate each company's fixed asset turnover ratio. So Hubert, you have the PP&E and the net sales. As you see here for Hubert, you take the 1850 and you divide that between the average of the PP&E. Then when we see Winslow, we take the sales divided again by the average of the PP&E. So we take 18 and 17, add them, divide them by 2. And we've got the 8.6 for Hubert, and Winslow is the 7.7. Let's look now at exercise 10.3. Nydia Corporation, a global technology company located in Santa Clara, reported the following information in its 2016 financial statements. So we have the PP&E and we have the income. How would we calculate the company's 2016 fixed asset turnover ratio? How would you interpret this ratio? So I'm going to give you a minute to think this through. So wouldn't you take the sales and divide that by the average PP&E? So you basically add them both, divide them by 2 to come up with the amount. So the fixed asset turnover ratio is 9.79 times. The turnover ratio basically indicates the level of sales generated by the company's investment in the net assets. Nydia is able to generate $9.79 in sales for every dollar that's been invested in property, plant, and equipment, PP&E. Sometimes a company will acquire an asset in exchange for an old or another asset other than using cash. This frequently involves a trade-in by which a new asset's acquired in exchange for an old asset and cash is given to equalize the fair values of the assets exchanged. The basic principle followed in these non-monetary asset exchanges is to value the asset received at fair value. This can be the fair value of the assets given or the fair value of the assets received plus or minus any cash exchange. In practice, we expect the fair value of total assets received to equal fair value of total assets given in a fair trade. However, in a trade-in, often the fair value of the new assets more clearly evident than the second-hand value of the asset traded in. We recognize a gain or loss for the difference between the fair value of the asset given up and its book value. So it's important to understand that the gain or loss recognized in these transactions, the difference between the fair value and the book value of the asset given. The amount of cash given or received generally has no effect on the amount of gain or loss recognized. The cash given or received simply serves to try and equalize the fair value of the assets exchanged. So the fair value of the new laser equipment is $580,000. We know this because American Laser was willing to trade the new lasers in exchange for old lasers worth $150,000 plus $430,000 cash. The journal entry records this transaction. So the new laser equipment is recorded at $580,000. The fair value of the old equipment of $150 plus the cash given of $430. This also equals the fair value of the new lasers. LCOM recognizes a gain of $50,000, which is simply the difference between the old equipment's fair value of $150,000 and its $100,000 book value. So the new laser equipment is recorded at $505,000. The fair value of the old equipment, $75,000, plus the cash given of $430,000. The journal entry shown on this slide records the transaction. The $25,000 difference between the old equipment's fair value of $75,000 and its book value of $100,000 is recognized here as a loss. It'd be unusual for a company to be unable to reasonably determine fair value of either asset in an exchange. But if the situation does occur, the company would simply use the book value of the asset given up, plus or minus any cash given or received, to value the asset acquired. For example, if fair value had not been determinable in the first illustration, LCOM would record the exchange as noted, shown here. The new equipment is valued at the book value of the old equipment, the $100,000, plus the cash given, $430,000. No gain or loss is recognized. A non-monetary exchange is considered to have commercial substance if future cash flows will change as a result of the exchange. Most exchanges are for business reasons and would not be transacted if there were no anticipated change in future cash flows. For example, newer models of equipment can increase production or improve manufacturing efficiency, causing an increase in revenue or a decrease in operating costs with a corresponding increase in future cash flows. It's rare, but if the exchange lacks commercial substance under a gain situation, then the exchange is recorded at the book value of the old asset. It's unlikely that an exchange that lacks commercial substance would be transacted where the fair value of the asset given is less than its book value. But if it occurs, the fair value of the old asset is used to record the exchange, and then the loss is recorded. So the journal entry records the transaction, assuming that the exchange lacks commercial substance. The new land is recorded at $3 million, which is the book value of the old land, $2.5 million, plus the cash given of $500,000. In this case, no gain is recognized. I'm just going to take a minute and read this. The Elkhorn Company traded a tract of land to Sanchez for a similar tract of land. The old land had a book value of $2,500,000 and a fair value of $4,500,000. To equalize the fair values of the assets exchanged, in addition to the land, Elkhorn paid Sanchez $500,000 in cash. This means that the fair value of the land acquired is $5 million. But since the exchange lacks commercial substance, the new land is only recorded for $3 million. We take away the old land versus the cash paid to show the cost of the new land. So again, another concept question. Arizona Pharmaceuticals exchanged laser equipment with a book value of $70,000 and a fair value of $75,000 for the newer model of laser equipment. Now, in addition to the old equipment, $90,000 in cash was given. So Arizona would record a gain here of $5,000. So the difference between the fair value of the old equipment and the equipment's book value is $5,000. Here's another one. Arizona Pharmaceuticals exchanged laser equipment with a book value of $70,000 and a fair value of $75,000 for the newer model of laser equipment. In addition to the old equipment, $90,000 in cash was given. So Arizona would record the new laser equipment at A, $95,000, B, $165,000, C, $160,000, or D. Nothing here is correct. So what we'll do here is we will look at the fair value of the old equipment along with the cash given. So the $75,000 plus the cash given will be the new laser equipment cost. So if we look at problem 10.6, Southern Company owns a building that it leases to others. The building's fair value is $1,400,000 and its book value is $800,000. Southern exchanges this for a building owned by the Eastern Company. The building's book value on Eastern's books is $950,000. Eastern also gives Southern $140,000 to complete the exchange. But in this case, the exchange has commercial substance for both companies. So our job is to prepare journal entries for both companies. So for Southern received cash of $140,000. The new building is going to be the $1,400,000 minus the $140,000, which is the new building of $1,260,000. We're going to get rid of the accumulated depreciation on the books, get rid of the original cost for the old building, and in this case, we're going to show a gain of $600,000. Now for Eastern Company, Eastern's building's fair value is $1,260,000, which is the $1.4 million fair value of Southern's building minus the cash that was given. So the new building is going to be $1,400,000, and we're going to get rid of the accumulated depreciation, get rid of the old building, show the cash given, and in this situation we would show a gain on the exchange of the $1,260,000 minus the $950,000, which would be the book value sitting on Eastern's books. So a company might decide to construct an asset for its own use rather than buying an existing one. Often companies act as the main contractor and then subcontract most of the actual construction work. The critical accounting issue in these instances is identifying the cost of the self-constructed asset. The task is more difficult than for purchased assets because there's no external transaction to establish an exchange price. Two difficulties arise in connection with assigning cost to self-constructed assets. Number one, determining the amount of the company's indirect manufacturing costs to be allocated to the construction, and then deciding on the proper treatment of interest. Are we going to use actual or implicit interest that would be incurred during the construction? Overhead allocation is a difficulty of associating costs with self-constructed assets. It's the same difficulty encountered when determining cost of goods manufactured for sale. So the cost of material and direct labor usually are easily identified with a particular construction project and are included in cost. However, the treatment of manufacturing overhead costs and its allocation between construction projects and normal production is a controversial issue. Some accountants advocate the inclusion of only the incremental overhead cost in the total cost of construction, which is the asset's cost would include only those additional costs that are incurred because of the decision to construct the asset. This would exclude indirect costs like depreciation and the salaries of supervisors that would be incurred whether or not the construction project is undertaken. If a new construction supervisor was hired specifically to work on the project, then that salary would be included in asset cost. Others advocate assigning overhead on the same basis that is used for a regular manufacturing process, which is all overhead costs are allocated both to production and to self-constructed assets based on the relative amount of a chosen cost driver. So, for example, labor hours that are incurred. This is known as the full cost approach and is generally an accepted method used to determine the cost of a self-constructed asset. To reiterate this, the cost of an asset includes all costs necessary to get the asset ready for its intended use. Unlike one purchased from another company, a self-constructed asset requires time to create it. During this construction period, the project must be financed in some way. So this suggests the question as to whether interest costs during the construction period are one of the costs of acquiring the asset itself, or simply cost of financing the asset. But on the one hand, we might point to interest charges to finance inventories during their period of manufacture, or to finance the purchase of plant assets from others, and argue that construction period interest charges are just costs of financing the asset that should be expensed as incurred like other forms of interest costs. On the other hand, we might argue that self-constructed assets are different in that during the construction period they're not yet ready for their intended use for producing revenues. So in keeping with both the historical cost principle and the matching concept, all costs during this period, including interest, should be capitalized, and then it would be allocated as depreciation during later periods when the assets are providing their future benefits. Generally accepted accounting principles are consistent with the second argument. Specifically, interest is capitalized during the construction period for assets built for a company's own use, as well as for assets constructed as discrete projects for sale or lease. So an example could be a ship or a real estate development. Now, this excludes from interest capitalization consideration of inventories that are routinely manufactured in large quantities on a repetitive basis, and assets that already are in use and are ready for their intended use. Interest costs incurred during the productive life of the asset are expensed as incurred. Next, period of capitalization. So this period of capitalization for a self-constructed asset starts with the first expenditure, the materials, the labor, the overhead, and it ends either when the asset is substantially complete and ready for use, or when interest costs no longer are being incurred. Interest costs incurred can pertain to borrowings other than those obtained specifically for the construction project. However, interest costs can't be imputed. Actual interest costs must be incurred. Because we consider interest to be a necessary cost of getting a self-constructed asset ready for use, the amount capitalized is only that portion of interest cost incurred during the construction period that could have been avoided if expenditures for the asset had not been made. What do I mean? Well, if construction had not been undertaken, then debt incurred for the project would not have been necessary, and/or other interest-bearing debt could have been liquidated or employed elsewhere. As a result, interest should be determined for only the construction expenditures actually incurred during the capitalization period. And unless all expenditures are made at the outset of the period, it's necessary to determine the average amount outstanding during the period. So this is the amount of debt that would be required to finance the expenditures, and thus the amount on which interest would accrue. So to calculate the amount of interest to capitalize is a three-step process. First, step 1, determine the weighted average accumulated depreciation. Step 2, calculate the amount of interest to be capitalized. And then step 3, compare calculated interest with actual interest incurred. Let's look at this. January 1st, Mills Conveying Equipment began construction of a building to be used as its office headquarters. The building was completed on June 30th, 2019. Expenditures on the project, mainly payments to subcontractors, were shown here. January 1st, $500, March 31st, $400, September 30th, $600, for a total of $1,500,000. January 31st, $600,000, April 30th of 2019, $300,000. On January 1st of 2018, the company obtained a $1 million construction loan with an 8% interest rate. The loan was outstanding during the entire construction period. The company's other interest-bearing debt included 2 long-term notes of $2 million and $4 million, with interest rates of 6% and 12% respectively. Both notes were outstanding during the entire construction period. So, step 1 is to determine the weighted average accumulated expenditures. Interest should be determined for only the construction expenditures actually incurred during the capitalization period. Unless all expenditures are made at the outset of the period, it's necessary to determine the average amount outstanding during the period. This is the amount of debt that would be required to finance the expenditures, and thus the amount on which interest would accrue. So for instance, if a company accumulated $1,500,000 of construction expenditures fairly evenly throughout the construction period, the average expenditures would be $750,000. But if expenditures are not incurred evenly throughout the period, a simple average is insufficient. In that case, a weighted average is determined by time weighting individual expenditures or groups of expenditures by the number of months from their incurrence to the end of the construction period. The weighted average accumulated expenditures by the end of 2018 thus would be calculated as $950,000. Now note that the average accumulated expenditures are less than the total accumulated expenditures of $1,500,000. If Mills had borrowed exactly the amount necessary to finance the project, it would not have incurred interest on a loan of $1,500,000 for the whole year, but only an average loan of $950,000. So the next step is to determine the interest to be capitalized for the average accumulation expenditures. To determine the interest capitalized, we simply multiply the construction loan rate of 8% by the average accumulated expenditures. So the interest of $76,000 is added to the cost of the building, bringing accumulated expenditures at December 31st, 2018 to $1,576,000. So the remaining interest costs incurred but not capitalized would be expensed. So it should be emphasized that interest capitalization does not require that funds actually be borrowed for this specific purpose, only that the company does have outstanding debt. The presumption is that even if the company doesn't borrow specifically for the project, funds from other borrowings must be diverted to finance the construction. So either way, directly or indirectly, interest costs get incurred. In this slide, even without the construction loan, interest would be capitalized because other debt was outstanding. The capitalized interest would be the average accumulated expenditures multiplied by the weighted average rate on these other loans. So the weighted average interest rate on all debt other than the construction loan would be 10%, shown by the $2 million times 6%, or $120,000, the $4 million times 12%, or $480,000. So as you see here, and the $1 million times 8%, or 80,000. The weighted average rate would be the $600,000, divide that by the $6 million. This would be the weighted average because total interest is $600,000 on the total debt of $6 million. So like in our slide, without any specific construction loan, interest capitalized for 2018 would have been $95,000, which is the $950,000 times the 10% rate. Step 3 is to compare the calculated interest with the actual interest incurred. It's possible that the amount of interest calculated to be capitalized exceeds the amount of interest actually incurred. If that's the case, we limit the interest capitalized to the actual interest incurred. In this slide, total interest cost incurred during 2018 exceeds the $76,000 of capitalized interest calculated. So it's not necessary to limit the capitalized amount. The method of determining interest to capitalize that we've discussed is called the specific interest method because we use rates from specific construction loans to the extent of specific borrowings before using the average rate of other debt. Sometimes it's difficult to associate specific borrowings with projects. In these situations, it's acceptable to just use the weighted average rate on all interest-bearing debt, including all construction loans. This is known as the weighted average method. For an accounting period in which interest costs are capitalized, the total amount of interest costs capitalized, if the amount is material, should be disclosed. So this slide shows an interest capitalization disclosure note that's included in a recent annual report of Walmart stores, the world's largest retailer. So let's take a look at a concept question here. On January of 2018, the Mateo Company began construction on its own storage facility. During 2018, $13 million in construction costs were incurred as follows. So we've got January 1st, $2 million, March 31st, $4 million, June 30th, $4 million, October 31st, $3 million. Mateo took out a $4 million 10% construction loan at the beginning of the year. The company had $20 million in other interest-bearing debt with a weighted average interest rate of 8%. The facility was completed early in 2019, so what amount of interest should Mateo capitalize in 2018 using the specific interest method? A, $600,000, B, $750,000, C, $680,000, or D, $660,000. So as you see here, what we'll do is the $7,500,000, which we come up with by the $2 million plus the $4 million by 9 months out of 12 months, plus another $4 million of 6 months out of 12 months, and then $3 million times 2 months out of 12 months. And then the capitalized interest of the $4 million times 10%, add that to the $3,500,000 times 8%, gives us the $680,000. Now let's look at problem 10-9. On January 1st of 2018, the Mason Manufacturing Company began construction of a building to be used as its office headquarters. The building's completed on September 30th, 2019, and we have a list of all the expenditures and the dates. So on January 1st of 2018, the company obtained a $1 million construction loan with a 10% interest rate. The loan was outstanding for all of 2018 and 19. The company's other interest-bearing debt included 2 long-term notes of $4 million and $6 million with interest rates of 6% and 8%, respectively. Both notes were outstanding during all of 2018 and 19. Interest is paid annually on all debt, and the company's fiscal year end is December 31st. So calculate the amount of interest Mason's going to capitalize in both 18 and 19 using the specific interest method. Then we'll determine what the total cost of the building is, and then the interest expense that will show up on the income statements. So as you see here, our expenditures that we saw earlier, let me just go back to them. Whoops. Our expenditures here of $1 million times the full year, March, $600,000 for 10 months, June 30th, the $800,000 for 6 months, and October, the $600,000 for 3 months. So we'll allocate those to come up with the accumulated interest expenditures before interest of $3 million, but the average accumulated expenditures are $2,550,000. So that $2,050,000 at a 10% rate gives us $205,000 of interest that should be capitalized in 2018. So now calculate the amount of interest Mason should capitalize in 19. So in 19 here we've got the $3,205,000 for 9 out of 9 months. In January, $270,000 for 8 out of 9 months. April, the $585,000 times 5 out of 9 months, and then August 31st, we've got 1 out of 9 months. So our accumulated expenditures before interest is $4,960,000, and our average accumulated expenditures are the $3,870,000. So how much interest should be capitalized? Well, the $3,870 minus the construction loan gives us the $870,000. Now the construction loan at a 10% rate for 9 months out of 12 months gives us the $225,000. And then the remainder at 7.2% at 9 months out of 12 months is the $46,980. So the interest capitalized in 2019 is the $271,980. And the building cost would be the $4,960,000 plus that interest capitalization cost would give us the total cost of the building to be the $5,231,980. I'm going to take a break here and we will continue on with part 3.